In this video, we will go through the accounting procedure for a partnership. A partnership is a business that has 2 to 20 owners. It is not a separate legal entity from the business owners. This means the partners will be held personally liable for the debts and losses of the partnership. When it comes to the balance sheet, the assets and liabilities account for a partnership is no different from that of a company. The unique thing about a partnership is the equity accounts, which comprises of the current account and the capital account. The current account records the partner's share of profit and his own private income and expenses. I will explain what I meant as private income and expenses later on. Since the current account records the profit attributable to the partner, it will fluctuate all the time. This is similar to the retained earning account for a company. The capital account records the capital contribution from each partner. It will remain constant unless the partner contributes more capital into or withdraws capital from the partnership. The capital account is similar to the share capital account for a company. Please note that each individual partner will have a current account and a capital account. So if the partnership is managed by 2 partners, you will see 2 current accounts and 2 capital accounts in the partnership's balance sheet. If the partnership is managed by 10 partners, you will see 10 current accounts and 10 capital accounts in the balance sheet. Like a company, a partnership's income statement will mention the sales, cost of sales, and operating expenses. However, a significant difference between the income statements of the 2 types of entity is the private income and expenses and the direct appropriation of profits to each owners. Depending on the partnership agreement, the partners may earn or incur private income and expenses. When I say private, it means the partner may earn an income that is directly obtained from the partnership's profit. Similarly, the partner may incur an expense that increases the partnership's profit. Private income and expenses essentially redistributes the profit of the partnership to the individual partners. Some private income and expenses may include interest on capital, interest on drawings, and the partner's salary. Now, I can understand that this part is rather confusing. I won't be surprised actually if you told me you don't know what I was saying just now. So to make things clearer, I need you to see the partnership and the partners as 2 different things. Again, please do not confuse this with the separate legal entity I mentioned just now. The separate legal entity refers to how the law treats the individual partners and the partnership as the same thing. But when it comes to accounting, I need you to see the partnership as the partnership and the individual owners as the individual owner. The next thing I need you to take note of is that my income is your expense. My expense is your income. If you have studied economics, you should understand what that means. So for example, let's say I hire a domestic helper to help me with my household chores. I pay her a salary of $2,000 every month. From my point of view, this is an expense to me. But from the domestic helper's point of view, this is an income to her. This is what I mean as my expense is your income. Essentially, the private income and expenses may be an expense to the partnership but an income for the individual owner, or vice versa. Let's start with the interest on capital. Interest on capital rewards the individual partners for their capital contribution to the partnership. Here, the partnership will pay the individual partners the interest on their capital balance. Since the partnership pays the individual owners, interest on capital is an expense for the partnership. From the perspective of the individual owner, it is an income to them since they are being rewarded for their capital contribution. The journal entry to record interest on capital is to debit interest on capital and credit the individual partner's current account. The debit interest on capital recognizes an expense to the partnership as a whole. The current account represents the profit attributable to an individual partner. So when we credit current account, we recognize an income that the partner has earned. Interest on drawings is a penalty for the partners when they withdraw capital from the partnership. If any partners withdraw capital from the partnership and the partnership agreement contains an interest on drawing penalty, the partner will pay the partnership the interest on amount of capital withdrawn. Here, the partnership will earn an income from the interest on drawings collected from the partners. So interest on drawings is an income to the partnership. From the individual partner's perspective, they pay the penalty, so it is an expense to them. The journal entry to record interest on drawings is to debit current and credit interest on drawings. By debiting current, we are reducing the profit attributable to the individual partners, which is essentially an expense to the individual partner. And by crediting interest on drawings, it recognizes an income for the partnership as a whole. Partner's salary, as the name suggests, is a salary given to the individual partners. This salary is often fixed and independent of the profit. Here, the partnership will pay the partners their salary based on the partnership agreement, so this represents an expense to the partnership. The individual partner, on the other hand, views this as an income since they are receiving a salary. To record the payment of partner's salary, we debit salary expense and credit current. Debiting salary expense recognizes an expense to the partnership, while crediting current increases the profit attributable to the individual partner, essentially an income for that partner. After the partnership has accounted for all the operating expenses and private income and private expenses, it will arrive at its net profit. The net profit will be shared with each individual partners according to the partnership agreement. Some partnership agreement may state that profits is to be shared equally among all partners, while some may specify that this partner gets 50%, that partner gets 30%, and the last one gets 20%. The agreement will vary. Anyway, just allocate the profit according to the profit sharing ratio as specified in the partnership agreement. The journal entry to record this is pretty straightforward. Just debit profit or loss and credit the respective partners' current accounts based on their share of net profit. The profit or loss account is a ledger account that works like an income statement, and it lists the balances of all income and expenses account. Let's do a quick example to see how this works. Assume this is a 3-owner partnership. The profit sharing ratio is 3:2:1. This is the partner's capital balance. Partner 2 withdrew $600 from the partnership. Here is the annual salary for partner 1 and partner 3. The partnership agreement stated that interest on capital is 5% per annum. Interest on drawings is 7% per annum. Finally, the net operating profit before charging private income and expenses is $31,500. Let's work this out together. First, we will record the interest on capital. If the interest rate is 5% per annum, we can calculate the interest on capital for all 3 partners. Next, we know that partner 2 withdrew $600 from the partnership, and the interest charged on drawings is 7% per annum, so the interest on drawings is $42. To record the partner's salary, the journal entry is pretty straightforward, and we should just credit the entitled salary to the partner's current account. Before we allocate the profit or loss to the partners, let's calculate the net profit after recognizing the private income and expenses. We take $31,500 less interest on capital, add interest on drawings, and less partner's salary. So we get the net profit of $1,242. This will be appropriated to each partners based on their profit sharing ratio as follows.